So before we get into the video, guys, this is going to be a long one. I didn't even realize it was going to be this long when I was recording it. I guess time flies when you're having fun, but I put a lot of value into it, a lot of good ideas, specific examples to help you guys out, and I'm going to leave a bunch of timestamps in the description so you could jump around throughout the video to help you kind of manage what's going on. So try to stick around to the end. There's a bunch of stuff going on, but enjoy. Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because you know schools aren't. Don't forget to subscribe for more videos. So let's get started. So there's been a lot of talk, especially recently in the year 2018, since the bull market has been extending for years. That there could be a possible crash in the near future. So in this video, I'm going over how to set up your portfolio for a crash to happen. Now stick around throughout the whole video, guys, because there are a lot of important aspects throughout what's going down. Some aspects that a lot of investors don't realize of what happens when you lose money, because it's actually worse than you think, and definitely other strategies to help you maintain your money and grow it even better for the future. Now, I talked about the possible probability of this happening, and there are probably dozens of videos out there, and I would honestly suggest looking over all of them to get as much knowledge as possible to go about this, because the last one was in 2008, and at least I'm assuming most of us have started investing after that time. So none of us have really been around for an actual horrible crash. There might have been sell-offs that made no sense whatsoever, and we're going to talk about that. So let's start with the year 2017 of last year, when the market was amazing. It was a great year. The overall market went up like 20%, maybe 30%. I think 20%. But a monkey could have made money last year. It was very easy to make. A lot of new investors could have got like 50+% returns, and that's fantastic. I'm glad you guys got that. But just realize, and obviously we're seeing this in 2018, it's not always that easy to make money. This year has been very rocky, all up and down, and very volatile. Now, everyone says that they're going to buy the dip, or when it crashes, they're getting in at the bottom, and in theory, obviously, that is fantastic. However, that isn't very simple, because when things are going down, everyone's frightened, no one knows what's going on, and we're all thinking like, can it go lower? Can it go lower? What's going to happen? And just because we're human beings, fear sets in. And some people sell out at a really bad time, usually at a low point, and that's how people lose money. One quick example of this, most recently, was February of this year. There was a correction. The overall market was down around 10%. And it really made no sense, to be completely honest. There was a sell-off. People were talking about interest rates and other things. But there was really nothing happening. It was just going down and down every single day. And I was also thinking to myself, like, this is not terrifying, because there was no evidence kind of backing that up. But you're like, can it go lower? And fear starts to set in. However, just like a normal correction, that was a normal correction. Things dropped around 10%. And if you were in the market during that time, how did you feel? Did you sell out? Did you do nothing? Did you miss that opportunity? Did you buy in? Because that was just like a small drop. That's a correction. Imagine a crash. So personally, I took a step back, evaluated what was going on in February, realizing it was kind of just a correction. It was normal and healthy for the market. And I actually got in a little bit in that correction area, funneled in like a few grand. And since then, it rebounded, just like most things happen. So a correction is a good like test of yourself, of how you would actually react, because when a crash happens, people aren't thinking it's like, oh, I'm going to buy, because that's not normal to think that way. but you actually should. So going back to actual crashes, the two most recent main ones was the dot-com bubble in 2000, and of course the Great Recession in 2008 with real estate. And we could see this is the S&P 500 ETF. You can see their crashes, ups, downs, and of course now you can see ups and more ups. So that's why people are concerned. Now, interesting facts of just a quick look at these charts of the distance between the peaks, of how long it actually took to rebound. And by the way, if you have like a super long time horizon, and that's a main thing to look out for, if you're like planning on just save or growing your money for the future, for retirement, you know, like 10 plus years, you really shouldn't care about these fluctuations. You could use them as a buying opportunity, or if you have like automatic investing every single month, I would suggest to continue doing that. However, from the peak of 2000, it dropped after that, obviously, and then it rebounded, and it took 7 years to get back to where it was in 2000, back in 2007. And unfortunately, there was another crash. So from 2007, it dropped and it rebounded, and it kind of started breaking even around 2013. So it took around 5.5 years to rebound. So going back to the chart, so you could actually see that it went up, dropped, rebounded, and you got back to where you were. Then you dropped back down, and it came back around 2013. So technically, if you had like the worst timing in the world and got in at the peak of 2000, it took you 13 years to get back to where you started. Now obviously you could see that if you continued to hold it, it went up since then, since 2013, and it's been up ever since, and that's great. However, during those 13 years, there was no capital appreciation. If you had dividend stocks, that was the only source of investment gains, income you had. There was no gain since that. If you have a single investment, I'm saying. And by the way, in 2008, the S&P dropped around 45%. A lot of stocks individually dropped around 50%. So that means if you had $10,000, hey, guess what now? You have only $5,000. It's kind of a hit to the gut. So this brings me to two things right now. The first thing, which how you have it set up helps you tremendously over the long term, and that's dollar cost averaging. That's a fancy way of just saying that you invest every single month. So if you have like a 401k with your job, you invest every single paycheck or month or however you have it set up. So that means when the market's up, you buy some. When the market's down, you buy some. When it's in the middle, you buy some. So it all kind of averages to like a decent buying opportunity. And so over the long term, you just grow your money. This helps you not buy at the peak, and you buy everywhere else. So once it goes up, you gain money on all of those entry points every single month. Then you could have that set up, like I said, with your 401k, but also your individual investments, like if you have mutual funds. Now this it sucks. It really does. And it's all in the math. And a lot of people don't realize this. I was going to college and we were going through stock analysis. I learned a lot of like different ratios and stuff like that. And we were going through this. I'm like, wow, I never thought of this, and this is that exact concept. So let's make it really easy. Let's say you have $100. Everyone could relate to that. So you have $100, and let's say the market crashes 50%, just like 2008. So you drop 50%, that means you have $50 left. And normally you would think, all right, well, the market dropped 50%. That means you need a 50% gain and you'll be back to breaking even. Until math comes along. This is why losing money absolutely sucks. If you have $100, drops 50%, you have $50. If you gain 50%, 50% of $50 is only $25. So you're not breaking even. You're actually at $75 now. This concept is very powerful, and one of the rules why Warren Buffett says never lose money, because it's so difficult to get back. So if you have $100, lose 50%, you actually need 100% return to get back to your $100. And this is definitely possible. I'll give you a couple more examples. We saw the S&P 500. You saw that drop almost 50%. And let's look at what happened with Apple. Everyone knows them. Back in 2008, they were around maybe $24 and they dropped to around $12. That's a 50% drop. So it's definitely possible, guys. But it's also even more interesting if you get in on those lows and it starts to rebound to back where it was, you're getting even more of a return on the way up. So those are two concepts to help you not lose as much money: dollar cost averaging, putting money in every single month, and then two, realizing that you should never try to lose money because getting it back is even harder. Now, how could you actually limit your level of downside? And this is where we're getting into the idea of diversification. Big word, simple concept. Instead of having one investment, you have multiple investments. And that's why mutual funds, it's basically a collection of a bunch of stocks in one. That's a mutual fund. That's why those are less risky than an individual stock. Because if an individual stock drops, your investment would drop by that amount. But if you have a mutual fund and that stock drops within that mutual fund, you still have those other stocks holding them up. Now, there are different types of stocks in the market. There are more risky stocks and there are safer stocks. So an example of a safer stock could be like a dividend stock that's been around forever, pays a healthy dividend. Even in bad times, people still buy their products and services. So that's considered safer. Let's look at one of those. One of my favorite is Johnson & Johnson. So Johnson & Johnson is like kind of healthcare pharmaceutical stuff. So many different products out there. And you could see, this is their 10-year chart. They dropped from, it was probably like high 70s, maybe 80s, pushing down to $50 in 2009. So Apple dropped around 50%, while a safer stock like Johnson & Johnson dropped by around 25%. So huge difference between the two because it is safer. So I first realized, all right, get some dividend stocks because that could help you out. When the stock is down, you're still getting those dividends as well, so that's great. But you still have to realize that 25% drop is still huge. And the idea of diversification isn't just the idea of getting a bunch of different stocks. You know, some go down less than others. The idea of diversification is not to get things that go down at different levels, but some that are down, some that are flat, and some that are even high during those points. Now, real quick, this is a dividend ETF that I'm about to show you. They have a bunch of different companies with higher dividends, so it's a little bit less volatile during those times. This is a Vanguard Dividend ETF, VIG. You can see that it still went down during 08-09, but it does have a dividend, so during that time it did pay those out, and it rebounded, so it wasn't as volatile. And you have to be aware of volatility because it could happen at any time. For example, most recent example that everyone probably heard of if you're interested in all about investing is Facebook. You could see that drop on Thursday. That was July 26th, dropped almost 20% in one day. I wanted to share that with you just because it's important to realize that it can happen, especially to large companies. 20% in a day is ridiculous. Now, could this be a buying opportunity? Possibly. Definitely do research into it. But also realize, like, that's when, like, things were going good for Facebook. Like, Facebook was doing great, amazing, wonderful. Then they reported, like, just good. It wasn't even bad. Imagine if they did report bad earnings or a crash was happening. It could be even worse than that. Now, basically every stock dropped during that time in 2008. This is some of the holdings of the S&P 500. The top holdings, like we saw before, Apple, Microsoft, Amazon, Facebook, and a bunch of other guys. So all of these dropped different percentages, but all of them still drop. Some might say, well, these are all American companies, all American stocks. What if we diversify outside of America? And you can do that, and I'll show you how. This ETF is the Total World ETF. The entire world is in this one ETF. You could see the holdings is actually very similar to the largest companies that we all know and love because they're huge. They're not just huge here, they're involved with the entire world. But you can realize that these are their top holdings and it only consists of just over 9% of the total assets. So there is a little bit more diversification with other companies, so it won't be as volatile, but it still will be. What you want from diversification isn't necessarily for something to go down not as drastically as something else. Diversification is when something goes down, something else stays the same, so it off balances, or something else even goes up when something goes down, so again, it off balances. So like we saw with this any type of stock, even foreign stocks, they went down, and that's not necessarily what we want. We want something that could actually benefit or complete disregard what's going on in the stock market. The different investments besides just stocks, there are others out there. For example, you can get stocks because there is nice growth there and you don't want to miss that. However, there are also bonds. There are also real estate investments. So there are definitely multiple investments that you can make to diversify even more. So we should go into that. So I was looking around because I was never into bonds because I realized that stocks usually always outperform them. So I'm like, why should I ever invest in bonds? However, to think of a bonds like to keep your money during like an uneasy time, to just keep it there because it still does have a yield and maturity and interest rate and all that stuff. So if you keep money over there, kind of let it hang out, and while the market crashes, you take it out of bonds and put it back into stocks so you could get that rebound. So that's exactly what we have over here. This is Vanguard Total Bond Market ETF. And this has a bunch of different bonds, and you could see this is around a 10-year chart. And it really doesn't move very much. Going a little bit deeper right now, you could see the yield of this ETF is 2.6% right now. So that means no matter what happens with the actual price, you're still getting that percentage as interest or dividend. So that's why it makes it very attractive. And since this is an ETF, there is an expense ratio. You do have to pay to hold this, but it's so insignificant because it is through Vanguard. Their expense ratio, 0.05%, probably like the lowest you could see. Now this is why, or the main reason why I wanted to show you this, because this is actual diversification. Instead of what we talked about before, let me show you the actual returns of this specific fund. So they did get started in 2008, so it doesn't have a huge track record, but you can see what happened during the crash. So they returned in 2008, like the crash we saw, they went up 5%, and if we look back to, let's say, a bunch of tech stocks, they went down over 41% during the same time. Now real quick, what I just showed you of a bunch of those technology stocks, that is part of, or something that mirrors the NASDAQ. That ticker symbol is QQQ. I'll show you right now. This is their max chart since around 99, around 2000. You could see that peak, and it dropped, and it remained below that amount, and it broke even after 14 years. And that's if you invested at the worst time possible, at the very peak. Now, of course, it is going up past that since then. But realize that if you invested at the wrong point, you know, it does happen. It took you 14 years to break even. Examples within those technology companies are the big ones that we all know: Apple, Amazon, Microsoft, Facebook, Google, and so on. So you have a little bit of stocks and you have a little bit of bonds. Now I'll show you the breakdown of what that specific bond ETF invests in, and these are just the different grades of bonds that they have. So they have most of their money in AAA bonds. So it's kind of a basic understanding. AAA is the safest, and the lower you go is the least safest. So like below B, just like grade school, something that you would rather not have. So they have a bunch in AAAs. They have some regular A's, triple B's. Now, why they don't invest all in just AAAs or government bonds is that with more risk comes more returns. So you could have a really safe AAA bond, but because it's so safe, you don't get too much returns. If you have a triple B, a little bit more risk, but you'll have a little bit more reward. So when you have a good blend of all of them, you could get a better return of than just a AAA. And going back real quick to the returns that they had since the fund started, you can see since 08, it was around like 5, 6, 7%. Recently, just a few percentage points. So not huge swings, but overall, and even in 2013, you could see that drop of just over 2%. Interesting point, just given that you have the same yield as today, like we saw before, 2.6%. Even if the value dropped 2%, you're still getting that yield of 2.6. So technically, you're still making a little money because of that yield. Now, this is what makes me a little concerned. Now, I'm going to show you a chart of how interest rates reacted over the past, I want to say like 30, 40 years or so. Well, no, since 1950. So, this is the chart that I'm talking about. Started in 1950, and you could see it spiked starting in the 70s and went crazy in the 80s. Those were interesting times. Now, when things were being adjusted, they started to get less crazy and started to go down. Now, here's a basic equation of how to figure out a bond's value. When interest rates decrease, the bonds increase. So now going back to the chart, since 1980 till now, you know, it was, what, 30 years plus? It's been going down. So, what do you think the bond values are going to do? They're going to go up. And that's what's concerning right now, because we were never, or since 1950, at this low point. You could see right now, the interest rates were basically dirt, and they're starting to increase. And the Fed has been talking about this. They're starting to increase rates because they can't keep it that low forever. So going back to the equation that I told you guys about, the inverse is true as well. When interest rates increase, which is what's happening now, bond values decrease. So that's why it's a little concerning. You could still get the yield or the dividend and the interest that they're giving. However, if you're holding like an actual bond, that value is going to go down. Now, that's why I liked the ETF that I chose for the total bond market, because it has so many different bonds in it. It has different terms. It has long-term, short-term, different risk variations. So overall, it kind of stays in the same general area. So it doesn't mean when these interest rates start going up, this value is going to start going down. Now, it might get affected in the short term, but overall, it's definitely diversification away from stocks, so that's why I kind of like that idea. So we talked about stocks, we talked about bonds. Now another way, and there are a couple different ways to invest in the next one, real estate. Another way to diversify away from the market, like the stock market, away from the bonds, you could also get into real estate. So there are two main ways that I'm going to go over real estate today. One is actually buying a piece of property, and you could play this multiple ways. My favorite, what I'm going to talk about now, you buy a property and you rent it out to an individual, maybe a business for like a larger property. But let's say you buy a house or an apartment, someone's going to live in there and pay you rent. And that's great diversification because it doesn't matter what's happening in the stock market. What happens with bonds? Because you're still getting that rent. Now, the actual home value could go up and down, especially in 2008. What got destroyed was real estate. So your home's value could have dropped significantly. However, if you kept that renter, you still would have got those rent payments. It wouldn't have mattered what happened with the actual home's value. Unfortunately, that usually costs a fairly large capital to get involved with real estate. Now, yeah, you can leverage it. You get a mortgage so you can control more and all that stuff. So you only need, I don't know, let's say $50,000 to control $250,000 property, but you still need a down payment, closing costs, and all that stuff. However, luckily, your boy did a little research, and I did invest in these previously. There's another way to invest in real estate. Instead of buying actual property, you could still invest in real estate in something called a real estate investment trust, also known as a REIT. Now, this is an example of an ETF of a REIT. You can see this is the Vanguard Real Estate ETF, and this fluctuates differently from the overall market because it's involved with real estate. Now, you could still see it did drop in 2008 due to 2008 was involving real estate, so that's why it got slammed. But otherwise, you can still get income just like rent from real estate. You get dividends from a REIT. You can see their yield is over right now 3.5%. So that's actually really solid. They invest in different properties. Could be commercial, could be residential, depending on the company involved. So you get decent income there. And since this is Vanguard, again, low expense ratio of 0.12%. Now, I don't want to go too into detail about like different tax implications. Technically, with dividends, you pay a lower tax rate. And with dividend income from a REIT, you pay a regular tax rate just because it's kind of considered rent. But still, that yield is impressive. I also wanted to show you a specific REIT that I owned a few years ago. I got rid of them since then. Not because it's a bad company, just because real estate, it's growth. It does have growth, but it's not like impressive growth. So it's kind of just like steady, slightly upwards, and it has that dividend as well. So that's why I figured I could get more return somewhere else. That's why I sold it. But I wanted to show you for one main reason. So this is Realty Income Corporation, ticker symbol O. They've been paying their dividends like for a long time. Very safe dividend payer. And by the way, dividend payers like regular stocks, they pay usually quarterly, every 3 months. Realty Income actually paid every single month, just like rent. So that's what was even cooler. But I wanted to show you guys this chart. You can see I kind of have highlighted 2000. And because I didn't want to show 2008 because it was involved with real estate. But the last crash of .com bubble 2000, all stocks went down. This company actually went up during that time. So this is another example of why diversification is actually a great idea. Again, do your own research before investing in that company or any of these different investments, but just to open your mind of you should diversify to minimize your risk, especially if you're thinking a crash is happening. Going back to what we said before, losing money sucks because getting it back is going to be harder. So we had the stocks, we had the bonds, we talked about some real estate. What are other investments? You could also have, very simple, technically everyone's an investor in it, is cash. Now yeah, there's inflation. Unfortunately, if you just hold it in a bank account, you're going to lose it to inflation. However, you keep your principal. So the stock market could drop, things could go to hell and back, but you will still have that money in the bank. Given that the bank doesn't implode and collapse and disappear, but usually big banks, they're usually too big to fail. To be completely honest, your money is safe. It's also insured by the government. So to keep money on the side, you're not going to lose any money there, neglecting inflation. But what's even more interesting, while stocks and other things might decrease, you now have cash available to possibly buy things cheaper, which is another great diversification strategy. Have more cash on hand. So if you guys have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say with this one because it's very important. What are some ways you plan on investing or to diversifying during this time of So don't forget to subscribe to my channel. I do have an Instagram account for some bonus content if you want to follow me over there, guys. So thank you so much for watching, and I'll see you in the next one.